Good morning, guys. Um, this morning, we're going to talk about um, a developing, well, it's here actually. It's kind of related to the non US perspective, but this is more to do with fintechs and basically fintechs using um, money transmitters, working with MSBs, the digital payments industry, and especially the idea of or the concept or the challenges with third party funds. As everybody knows, most or a lot of fintechs have lots of themselves customers, and then a lot of fintechs will integrate or engage with another fintech that is specializes in digital payments, or they will engage with the PSP. Many fintechs nowadays are payment service providers themselves. And payment service providers are connected to banks via, banking sponsorship arrangements or what have you. They have FN, they have FBO uh, accounts, which is for the benefit of, which means that the payment service provider is handling the fintechs, their customers, funds, which consists of many customers of those fintechs. So that's why they call third party funds. Now, in normal cross border banking, um, you are not allowed to, unless you have a contract with your client, the client, you're not allowed to move third party funds via banks without knowing who the beneficial owner is. And payment service providers that are moving funds for other fintechs are doing this to some extent, but they are either licensed as money transmitters, they have a bank sponsorship arrangement with their bank, and they have, the type of compliance frameworks in place to deal with that, right? So what that means is that there are a lot of digital payments fintechs that are payment service providers that are moving essentially third party funds for their clients, and they're doing this in conjunction with their banks and the bank sponsorship relationships that they have. And this ties in nicely to the relevance of the non-US perspective that I keep talking about, which is why, and if you're doing that, say, we're going back to the US. If we're doing that, if the payment service provider is moving money domestically in the US, that is not a problem. Or it tends not to be a problem, certainly in my experience. I have worked with a number of fintechs that are payment service providers, and they're licensed as MSBs or TSPs or whatever, and they're moving funds around between PSPs located in the US. They're working bank sponsorship arrangements in the US. However, in the second example, as soon as the payment service provider is moving funds outside of the US, cross border, you're in a completely different world. And I have seen a range of problems occur with the situation where payment service providers are moving funds cross border outside of the US. Likewise, if non-US fintechs are set up and operate in the US, and we're quite aware of quite a few fintechs from Latin America, from Africa, from Europe. They set up in the US, and obviously what they're doing is they're attempting to collect payments, traffic, funds from their clients via entities in the US. And then the plan essentially is to port those funds across the Atlantic to their nodes and frameworks in Europe and onwards to terminate to wherever they terminate to in Europe or Asia or what have you. The problem with anything non-US or any cross-border transactions from a US perspective, it's hard enough if you are a US fintech. If you are not a US fintech, then it's even more difficult. When I say non-US, you're owned by non-US persons. And that's even more challenging. But it's also challenging for US persons who own fintechs in the US who are moving funds across borders. So we all know, if you're in this industry, you'll know the offerings of compliance service providers. Compliance service providers are, you have AI compliance service providers nowadays. And all of these compliance platforms, Google offers AML, KYC checks using their system. They're using machine learning. AI compliance companies are out there now. So the global financial system is becoming more transparent by the day, by the hour. And as the system becomes more transparent, it is clear that, especially with these AI compliance engines that are able to unravel and detect layers of activity, right? As people use various service providers in various ways to try to circumvent the legal system or what have you, these AI engines can detect that activity. So the global financial system is becoming more transparent. So what's happening is this is creating, for now, a real problem for any fintech doing cross-border business, which is non-US business, any fintech that is owned by non-US persons, and for sure, so any fintech, especially dealing with third-party funds and looking at moving funds across borders. And this is becoming, this is going to get worse in the coming days and months. I'm very surprised. I'm not surprised, I should say, because I've been writing about the impact of the global transparency system on international tax law for a long time. The way we do international tax structures has changed because of the transparency of the international tax system, as in what may not have been looked at before. And I'm not talking about tax evasion, I'm just talking about robust structures. What would not have been looked at previously can now be picked up and assessed and flagged by an AI mechanism. Obviously, tax authorities and regulators are using AI. Why wouldn't they? Of course they're using it, because it actually puts them back in the driving seat. Compliance, as we all know in our businesses, is in the driving seat and is determining what can and cannot be done when it comes to cross-border structuring. So the non-US perspective and awareness of this is now so important. And I'm not, again, we're never talking about multinationals, the people in the headlines, Amazon, Apple, Walmart, I get all these magazines from payments industry, fintech industry, and the first 20, 30 stories are always all about these large, very famous multinationals, people that has raised hundreds of millions of dollars. And I am not talking about that. I don't serve them. I don't work for them. The people that I'm talking to here are owner operators of SME, small to medium sized fintechs. Uh, you're either a US fintech doing international business, or you're a non-US owned fintech and you're trying to do business in the US, working one way or another with bank sponsorships and with whoever. And those are the people that I'm talking to, because what people will find is that they're, especially non-US persons working in the US, you will find that your relationships with banks, with regulated financial service providers is going to change, and your service levels will become harder to meet because the global financial system is becoming more transparent. Meaning, the compliance people now have AI, and they're going to apply it to flag. I have a number of fintechs as clients, and you know, I sometimes sat down in meetings where they're looking at sometimes hundreds of flags that they have to now work and investigate. And these flags are thrown up by some very powerful AI compliance systems. So, a lot of fintechs in the US, owned by US persons or by non US persons, are licensed as, they have licenses, like licenses to do foreign exchange, licenses to do MSBs, money service business, money transmitter business, whatever you. And I think the time has come where what is going to happen, and we've kind of seen some evidence of this in the last month, where a lot of the some large fintech businesses, Circle, Ripple, who was the others? One or two others, Fireblocks, have run and applied for banking licenses, bank and trust licenses. And the reason they have done this is because they can see that there is a need for fintechs to move beyond. There is a need to move beyond being a sort of a quasi-licensed, quasi-regulated entity, because obviously the MSB, money transmitter, third-party service license categories, FX, these are not prudentially regulated financial service providers. Same thing with fund administrators, investment funds, investment managers. They are not prudentially regulated either. But the only way to maintain the ultimate service level and be in control of your access to the global financial system is really going to be determined by if you are a bank or not, or licensed like you have access to a bank, or you are structured. There are a number of ways that you can structure so that you are essentially covered by a regulated entity, and then you will have access to the global financial system. And so you are going to, a number of people are going to have to work with regulated service providers like trustee companies and banks, focusing on this area of dealing with fintechs who are dealing with third-party funds. This is where I see things going. So we, as a group, have forged a close working relationship, and I'll use this as the example with, because I can't solve everybody's problems. I can only talk about what we have done. We are working closely with a regulated trust company in Canada. And this regulated trust company is, it's regulated in Canada. and its owners have a lot of experience in the digital payments fintech industry. And so they are able to take on relationships with fintechs who are dealing with third party funds, who are licensed as foreign exchange, they're licensed as money service business, they're licensed as whatever, as money transmitter licenses. And the reason why the trust company is able to do this is because, as a corporate trustee and of a regulated corporate trustee, they are able to work. They have a corporate trustee custodian relationship, meaning they have their relationship with their custodian. This is type of relationship that a quasi-regulated entity, which is like a FX company or a fund administrator or an MSB, wouldn't be able to get a custodian relationship with, a mainstream bank, because they don't have the type of regulated status, the level of regulatory cover. So I would say the top tier of regulated entities is going to be banks, trust companies, and any version of the two of those, because you can have private banks, you can have, smaller boutique trustee companies. And the regulated trustee company is able to, of course, being regulated, it doesn't have a problem maintaining its custodian relationship with the banks and the custodians that it deals with. And the trustee company is in the process of cutting many different relationships with many different custodians. It's digitally native, so it's integrating with multiple custodians, because it's going to be able to provide that cover, that relationship, to multiple fintechs. So in particular, fintechs in the US who are doing cross-border business, even though the trustee is a Canadian company, it will be able to work with US custodians as a corporate trustee and provide a segregated account, sub account type structure integration to fintechs. And obviously it has that relationship. The trustee company already has that relationship with its custodian. And then the custodian, the trustee company is working with its gateway, which it has obviously got from a digital payments company. And it is lining the three of these up together and providing an uninterrupted service level for the fintechs. And so I think there's going to be a very big move towards fintechs moving towards getting a relationship with a corporate trustee company or a private bank or a custodian. And actually I should not a private bank, with a custodian, because the only way it's going to work is if the fintech basically has a relationship with a custodian. And the only way a fintech is going to get a relationship with a custodian is via a corporate trustee company. And that's the only way that I can see this panning out, and it's begun to happen already. There is no way for a fintech to get access directly to a regulated custodian in that way. That's something that a corporate trustee regulated and licensed to do under the legislation of whatever jurisdiction that it's in. I don't see a lot of trust companies getting into this business because I think a lot of existing trustee companies have large books of private client business that they will not want to change their business model and interrupt those clients and their legacy cash flows. But of course, people can change, people can move their they can move their existing businesses into other businesses and then enter the space. So I'm not going to go on about the fact that there aren't many trustee companies that will do this type of business with fintechs. I just think that a corporate trustee company that can do this business with fintechs is really well positioned to help them maintain service level, to maintain relationships with custodians and ultimately banks. I think this is going to be the model going forward. And yeah, I mean, it's just amazing to me that this is kind of how it has come about. I think in the US, I think you will see, I think many fintechs already, I've seen at least 6 or 7 fintechs struggling already with their bank sponsorships, with their relationships with banks. I have seen in Canada, the law now mandates, the Retail Payment Activities Act, I think it's called, now mandates that fintechs use a custodian. What that indirectly means is that fintechs in Canada are going to have to go and get a corporate trustee that has access to a custodian. Because banks are not going to, most banks are not going to book those fintech clients in that way. A lot of them aren't nimble enough. A lot of them aren't going to spend that kind of time because banks, of course, their business model is deposits and moving money, keeping money on deposit and then, yes, moving money. But, it's a lot of big banks aren't nimble enough to do this, especially when it comes to all of the integrations and to do this digitally. This is why banks in the first place have engaged with fintechs, but now the regulator has stepped in and said that what this really is a sort of a shadow banking system that is emerging, because really all these fintechs that are moving third-party funds are really acting like banks or corporate trustees. I mean, you could probably argue that a lot of agreements that fintechs have with banks via bank sponsorships, you could create it's really a constructive trust. The fintechs are holding funds on trust for their clients and their clients' clients, and then moving those funds via digital platforms to other payment service providers, either domestically in the US or outside of the US. And so there is between the fintech and the bank that is providing the bank sponsorship, there is a really a trust. It's not express. It's not segregated like you would have with a private client. And so I think what the regulators are seeing is that if they don't put some structure around this, you'll have a lot of technology digital companies. I mean, I haven't even begun to talk about wallets, companies that are, and I'll get to that in a second, because I'm just dealing with fintechs. Regulators have realized that fintechs are creating a sort of a shadow banking system, because if you look at bank sponsorship relationships, quite often the bank is not responsible for doing detailed compliance on the payment service provider's clients. The payment service provider is, but the payment service provider is not regulated prudentially. And so the payment service provider, the digital payments company, which has many fintechs as customers and many merchants as customers, it really is playing the role of a bank without the regulatory obligations in place. And as this escalates, this would become a problem for the financial services system. So there are some, and I gotta dig these out, but there are some articles where people describe Starbucks as a bank. And the reason they discuss Starbucks as a bank is because Starbucks has, as we all know, is wallets, where I know when I lived in Florida, I used to love putting 50, 60 bucks on my wallet. And then when I go up to the drive-through, I can just scan, and I don't have to take out my card and go through the, well, even though your card is touch nowadays, at least I could just use my phone. I could just bring up, my app, get it scanned, and it all, and it's done. But last I saw, Starbucks had nearly $1.5 billion ultimately of customer funds on its balance sheet. Now, Starbucks is a coffee company, it's not a bank. Wallet technology is proliferating quickly. Very soon, within 2 to 3 years, the number of corporations that will be using wallets, digital wallets, in conjunction with their customers. Just imagine airlines, loyalty points, airlines, I guess, as well. They may not, but they could do wallets, give wallets to their customers, so that, we can already use tickets and put them in our Apple Wallet. Apple gives everybody wallets for credit cards and all these different things. Apple's not a bank. Apple must have a significant amount of client funds on its balance sheet. But all these other corporations, buy now, pay later, all these different business models that are proliferating, and wallets, digital wallets as well, gives companies, normal commercial corporate companies, the ability to act like banks and have that type of relationship with their customers. Well, that is what a shadow banking system is. A shadow banking system is where millions of people or lots of people have put money with companies, and those companies are actually not banks. That's normally we keep our money in banks. Now what's happened is technology has enabled us to, for convenience, for speed, for whatever reason. Like, the reason why I did it with Starbucks is for speed and convenience. It's a good thing. But at the end of the day, from a regulator's point of view, Starbucks has $1.5 billion of customer funds. If Starbucks run into problems of one sort or another, Starbucks' obligations is to its shareholders, not to its customers. And so if Starbucks ever ran into financial difficulty, bankruptcy, or anything like that, all those customer funds would be endangered. And there are other system-wide problems caused by having that amount of money in non-banks. So that's what you call a shadow banking system, where there's lots and lots of money in non-banks. Sometimes countries create situations where people have money outside of banks, and they call that a shadow banking system. So in Canada, they have already mandated that corporations using embedded payments of one type or another, fintechs that are handling third-party funds, payment service providers, have to basically use a regulated custodian. The only way they're going to be able to use a regulated custodian, they have to do this in 2025. The only way they're going to do this, use a regulated custodian, is essentially by is going through a trustee company. In Europe, in London, Europe, London, I think you're seeing the same thing in the UK with EMIs, electronic money institutions. You have statutory trusts now, where those are playing a role in dealing with customer funds, third-party funds, digital wallets, and all these types of things. And in the US, I think what you're seeing is it's just happening where regulators and compliance departments are resiling against the risks posed by third-party funds. And a lot of financial institutions and this where we come back to the US perspective now, the domestic perspective. A lot of US domestic businesses are not in the business of, as they see it, of dealing with international risk, meaning moving funds cross border, because they can make a lot of money doing US domestic business, and they don't have to give a second thought about cross border, the risks. They don't have to deal with it, they don't have to worry about it, they have to expose themselves to that. Their profit margins aren't impacted if they don't go cross border, because US has some of the deepest markets in the world. So this is emerging. This is why we've spent some time building a relationship with a corporate trustee company in Canada, so that we can essentially introduce our clients to the owners of that. And I only work with trustee companies whether I know the owners, or private banks small private banks where I know the owners. I'm not lucky enough to have large clients that use a lot of these large private banks where your relationship is with the relationship manager. I'm not fortunate enough to have a lot of that type of business. So I deal with boutique private banks where I know the owners, where they can see what type of decisions that they can make. So I'm gonna, go into this more, into more videos, talking about the non-US perspective. But already I've had 3 or 4 meetings in the last month with Latin American fintechs, a couple of African fintechs, and explaining the same thing about the environment, and that these guys, you need to look for a corporate trustee, get integrated with the corporate trustee and their regulated custodian. You need to have segregated accounts and sub accounts and everything in between. And this is a real cost of doing business than to the way it was before. But I don't see anything else as being is not going to be scalable. This is just, as usual, this is, I'm not spending a lot of time trying to convince people. As I said, the reason why I make these videos is so that people can get the transcript, or they can listen to it or watch it or whatever. And it saves me time. I can send you the link to this video. You can see that I put it out there in public. I'm not, this is something that I would say to anyone. This is not just a specific thing that I've made up, to tell you in our meeting. So this whole process of putting content out there is very useful, because you can see that I'm talking to whoever in the world cares to listen to me. Not that there are many, but it's still useful. It's out there for sure. So non-US fintechs, US fintechs doing non-US business, non-US cross-border transactions. You guys need to get with a corporate trustee and a regulated custodian segregated accounts, sub accounts. You need to get into that system as soon as possible because things are changing very, very quickly. And uh, in Canada, it's mandated already by it's already mandated by law. Um, and so people need to really think through if they're international and they're going into, out of, or around in the US, you need to access some serious regulatory infrastructure if you're basically going to survive. Otherwise, compliance departments in the US, and 99% of them are not they don't have an international perspective. 99% of them are very busy, happily. They're going to make tons of money doing US domestic business. They don't have to change their perspective. Don't be distracted by the large multi-billion-dollar fintechs who can get these US firms to change their or apply an international perspective, because of course in those cases they're being paid to. Small fintechs, and when I say small, those of you doing less than a couple $100 million of business, not transactional business, but in terms of the net profits that you generate, the net revenues that you generate. If you're doing less than 100 million, then you know you probably don't have the resources to really get the attraction of these large or any U.S. regulated service providers, banks, or trust companies, because they are busy making a lot of money in the U.S. domestic market. Why should they take on cross-border risk for no return? If you can find a U.S. corporate trustee bank or whatever that is focused on the cross-border and international, and there are some out there, it's just that I don't know them. In other words, I know of them, but I don't know them, so I don't recommend any. But there are some. If you know them, great. You can use those. You can work with them. You're likely to find a few, I would imagine, in Miami, because Miami is a very cross-border place. U.S. is the New York is strange. New York has a lot of the problem with the U.S. I think with New York, is that there's just so much money going through New York. Okay, as part of the global financial system, it's like London. Yes, it's international, but that stuff occurs at a very high level because they make a lot of money. So getting a large U.S. firm that is focused on international in New York, if they're in New York, they're doing big stuff, and dealing with SMEs is a lot of them essentially what they're saying is it's not worth their while. So yeah, third party funds, corporate trustees, regulated custodians, doing any type of international business into or from the US. These themes are now coming together and are intertwined, and you need to be aware of these things, and you can choose your way forward accordingly. But yeah, just don't assume that you have arrived in the US or you're in the US and that whatever banks or whatever relationships you're pursuing or going through, that these people are going to necessarily solve your problems. Ultimately, often, no, they won't, because their perspective is different. You would have to pay them to solve your problems. And let's face it, a lot of fintech owner operators are not running around spending vast amounts of money trying to hire consultants and pay firms lots of money above way above average to entice them to solve their problem. That's not the way the owner operators of SMEs start or even get down. And you know who you are. You know you don't operate that way, which is fine. I mean, that makes complete sense. That's why you guys are good business people. So it doesn't make sense to do that. So yeah, feel free to drop me a line if you want to talk. But if not, then that's cool. Just make sure that you save yourself some time and aggravation, and hopefully you can look into some of what I've said. Ask the U.S. advisors what their focus is. Ask the U.S. banks how they make money and what their focus is. You can do a desktop review, but then the people that you're meeting, you can ask them. Employees in particular, ask them, because a lot of employees don't know that they have a U.S. domestic perspective only. They of course are focused on more business, and then they come across an international more, and then of course what happens is they can't fit the international into the U.S. domestic perspective. It's a square peg in a round hole, and it doesn't work. So save yourself the time and aggravation. All right, guys, that's it for this one, and see you on the next one. Cheers.